Todd Baker, how you doing, my friend? Can you let me know how the audio sounds for you? Is it coming in okay? Okay, great, great. Glad you folks could help me out with that. It's been a while since we've had a live stream, so gotta expect some rust this morning here in Singapore. It's probably night where you folks are at. Kirsten Strand, how you doing? Todd Baker again, how you doing? Logan Nab, first time I've seen your name here. Thanks for joining us. Sean McDonald, how you doing? Robert Lockett, how you doing? What was with that kit code chart? I didn't look at it. I haven't taken a look at that kit code chart yet. I should at some point, I suppose. What's wrong with it? Why was it weird? Oh wow, 23.37 silver for 2 minutes. Well, let's hope we can see that for more than 2 minutes one day, and one day soon. Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, and we are here with another live stream. So we thank you for being here with us today. It's early morning in Singapore. Well, actually, mid morning. It's 9 a.m. here. Monday morning in Singapore. It's probably evening wherever you're at. So, again, we thank you for joining us. And if it's your first time here or you haven't already done so, please do remember to subscribe and click on the bell to be notified of new updates. And if you like what we do, give us a thumbs up. We really do appreciate it. And again, if you'd like to follow us, you can do so on our social media platforms, where our website is silverbullion.com.sg. Again, we are in Singapore. Silver Bullion SG for our Facebook page, Silver Bullion or at Silver Bullion PL for Twitter. If you just want the audio versions, bit.ly, bit.ly, SBTV iTunes, and SBTV Spotify. And if you want to join our Crisis Tracker group, which is a Telegram group where we communicate with you guys, go ahead and open up your Telegram apps, and you can find us at t.me/crisis tracker. So those are more or less our links that you can follow us on. So again, thank you for being here. I know it's been about 3 weeks or so since you folks had the relief of not seeing me so much, but been pretty busy with work. So again, glad you're here. Taking a look at the names, Paddy, Padd. Hello, how you doing? Let's see. Todd Baker, Northern California. Great. Had the pleasure of going to Sacramento a couple times. Spent a little bit of time at Travis Air Force Base as well. Pablo Pina, good to see you again. Taylor Dodson, did someone else see the Kiko silver chart? Silver spiked to 23, then fell quickly. Yeah, again, Todd, I didn't see that, so would be good to maybe take a look at it and see if any of you also had seen that as well. Archer Yee, silvertiger.com. All right, we'll give you that one. Okay. Pudenda Johnson, hey, how you doing? So again, we thank you all for being here. Really appreciate it, and appreciate the support. So let's take a look at the current silver and gold price right now as it stands. This is our website, silverbullion.com.sg. Again, we do take a lot of different currencies, so that might be in your favor. US dollar right now, we're seeing silver at 16.90. So let's if you didn't buy the dip, I hope you got in on it, but I personally would like to see it get back up 17, 18 preferably, or even more, but that's just me. Gold up a little bit. So again, gold, I think it was a pretty decent time to buy the dip. I mean, I think we had some news with the trade war and some type of small agreement that kind of set the markets upwards, pushed the metals downwards, and then there was a little bit of a retraction, and then we maybe will see the metals start to move a little bit upward. But again, it's more than just the trade wars going on. There's a whole bunch of stuff going on. Todd Baker, Travis is great. Yeah, Travis is. I like Travis. You know, it was nice and cool up there. Coming from Hawaii, it was the first time I saw a squirrel running up a tree. It was a big deal for me. But yeah, Travis is good. Duemi, San Francisco Bay Area. Okay, yeah, San Francisco, nice. It's a nice. I like the old feel to that town. I guess depending on what part of San Francisco you're at. But that this was decades ago. That was the last time I was there. Any predictions on the reset? Yeah, it's going to happen, but that's about as much as you're going to get from me. Predictions will definitely start to wear on people. I mean, we've had a lot of guys that tried to give predictions. I mean, I think probably one of the most more famous ones was Bull Pony. I know he gave a lot of predictions, and you know, he paid for it. You know, and so you know, a lot of guys they kind of want to stay away from predictions now after seeing what happened. Kirsten Strand, yeah, I hope silver at least stays in this close range. I'm more comfortable when it's in the $17 range. So we'll have to see what happens. Lieutenant Colonel Rod Rumley, how you doing, sir? Glad you could be here with us. Okay, so checking some of the news, we are seeing that China sells its first euro bonds in 15 years, and this is kind of a big deal. Strong demand as China seeks to rely less on the US dollar. And we've been talking about this for a while where there is de-dollarization going on. I think this is a totally separate issue from where you have on one side a strong dollar and then on the other side you have de-dollarization. So it's a bit of a mix going on, but I think eventually it's going to play itself out and we're all going to see what exactly is going to happen. But do note that countries are de-dollarizing. So China sold bonds in euros for the first time in 15 years, a move that could encourage Chinese companies to follow suit. On Tuesday, China issued 4 billion euro bonds due in 7, 12, and 20 years. The deal was split between 2 billion euro and 7-year debt with a yield of 0.197%. Um, okay, these are basically the numbers part, but we want to get into the more the nitty gritty. Demand was strong with investors, including the banks managing the deal, placing orders totaling more than 19.5 billion euro. It's a departure from the past 2 years when the only foreign currency bonds in China issued were in US dollars. It sold 3 billion of dollar debt in 2018 and 2 billion the year before. So again, a bit of the dollarization. For the past decade, Chinese banks and companies have primarily issued global bonds in US dollars to target the world's largest pool of liquidity. So far this year, they've sold 180 billion of such debt versus only 7.7 billion in euro denominated debt. However, Chinese borrowers are starting to think about cutting their heavy reliance on dollar funding, some bankers in Asia said. Among other things, some issuers are worried that U.S. investors might in the future be pressured to avoid Chinese debt, bankers said. So again, you know, China's making the moves that they feel is in their best interest, as China always does. Um, you know, there's nothing wrong with that. I mean, countries are moving away from the U.S. dollar. Sometimes, you know, dollar tends to be weaponized, and more or less the world has had enough of the weaponization and the debt. Um, that's basically what it comes down to. And you know, I guess it's something where if the shoe was on the other foot, as they say, or if you're walking in their shoes, you you might you might see it that way as well. On the U.S. side, you know, it's uneasy, it's unsettling, but you know, it's the powers that be, you just never know what they're going to do, and each country is going to do what they have to do. And one of them, another one, is India. This one's a bit different now, a little bit interesting. Why your gold is safe and may not attract a government crackdown. Okay, so this is a little bit different from what we normally hear, but this is coming out of Mumbai, India. It's unlikely that the government could be planning a surgical strike on hoarding of gold by Indian residents, nor is the demonetization like move or an amnesty scheme likely to be rolled out in the near future. I mean, I think you guys are pretty well aware the history of India and the government. They are always trying to sort of get their hands on gold in some way, tax gold in some way, but now it seems like they're trying to do something else. A member of the Central Board of Direct Taxes who spoke to Business Line on condition of anonymity, everybody likes to be anonymous nowadays, right? Pointed out at a press release issued by the Apex tax body in 2016, which specifies a government position on holding of gold by Indians. According to the member, the circular was issued by the Modi government, and it is unlikely that the government will keep changing its stance, which could create uncertainty in the financial markets. That is true. India is it's always changing their positions. News reports by leading media channels and news portals have suggested that the government could announce a one-time amnesty scheme for declaring unaccounted gold. Okay, and holdings beyond a limit which cannot be explained will be taxed at 30 to 33%. The news has gone viral on social media. So I guess you're going to need to have to prove where you got it, if you have enough money to buy it, where it come from, and the government might kind of let you go. So an official statement. Well, this is the official statement. Okay, let me scroll down a bit. Their official statement is there is no limit on holding of gold jewelry or ornaments on anybody provided it is acquired from explained sources of income, including inheritance. Instructions have been issued in the matter of search and seizure of gold jewelry, ornaments, and jewelry to the extent of 500 grams for a married lady, 250 grams for an unmarried lady, and 100 grams for a male member would not be seized even if prima facie. It does not seem to match the income record of the assessee. The officer conducting the search has the discretion not to seize even higher quantities of gold jewelry based on factors including family customs and traditions. The press release was issued by the Ministry of Finance. So it goes on to say a few things, but the interesting part is they mentioned gold jewelry, but nowhere to be found was bullion. I've read it a couple times, and they didn't mention anything about bullion. So again, let's all be careful what we read, because sometimes some things are, like how they say, hidden in plain sight. So there you go. Taking a look at some of your questions before we move on. Let's see. I hope silver stay right. Okay. Fishy. Yeah. Let's see. Everyone is okay. Talking about the price jump, right? Okay. It's called reserves. Q Duck Smack. First time I've seen you here. Welcome aboard. It's called reserves when governments hold gold, but hoarding when we do. Yeah, we're just terrible people who like to hoard gold, right? Hoard as much as you can. That's what I say. Let's see. Viking for Jesus. I saw the $23 spot price as well. Nearly fell out of my chair. Turned on the news right away to see what happened in the world. Nothing. Okay, Scottsdale Mint prices also reflected the Kitco price jump for a few minutes. A glitch. Yeah, I mean, it happens from time to time. You get a feed, and a lot of times the feed, um, what a lot of websites will do is scrape the feed. So whatever the price may be, a lot of websites will scrape it, and they'll reflect that same feed. So if one feed goes bad, you'll see the feed going bad in other places if those places are also taking or scraping from the same place. So it could have just been that. Let's see what's happening on November 19. I'm not sure, but I need to check on that. Sorry about that. But I hope you have all your turkeys by then, because you're gonna need a few days for it to thaw out, right? So by 11/19, make sure you have your turkey if you're in the states. Let's see. Pablo Pina, when do you think we'll see cobalt demand climb again? I think the demand it's there. I think, I mean, this is just not through analysis. This is just my gut feeling on it. The batteries still need cobalt. It is true that they're trying to find chemistries that use less cobalt, but they still need it. And it's not just the car battery industry. There's electric vehicle battery industry, I should say. Cobalt's used in a lot of other things. From what I understand, jet engines, quite a few other things. I think it's more about being politically correct, and where the cobalt is being mined, how it's being mined, and who is doing the mining. A lot of the world's supply of cobalt comes from Democratic Republic of Congo, and there's been reports, or there's been reports that child labor is being used to mine the cobalt. And then on the other half of it, I believe over half of the world's cobalt is refined in China. So you're seeing two things there. One, cobalt is coming from Democratic Republic of Congo, where there are issues with child labor, and then most of it is being refined in China, where I think it's fair to question, okay, if it goes in China, will it come back out from China? So it's a fair question to be asked. So I think, right now the market does need it. No doubt the market needs it, but I think there's just a few questions that need to be answered. So we'll see what happens with that. But I think, they still need cobalt. The demand for cobalt, it's still there. Let's see. Kirsten Strand, yes, buy silver tomorrow. Okay, buy silver today. Buy it every day if you could. Let's see. Okay. All right. So let's take a look at one of our favorite or one of my favorite people in the world. I know you all like her as well. She is Christine Lagarde. Yes, we all love Christine Lagarde, don't we? She's always looking out for us, right? Anyway, an article from Zero Hedge came out where Christine Lagarde says we should be happier to have a job than to have savings. Sort of like let them eat cake, right? I think it struck a lot of people that way with what she had to say. Anyway, we'll go into it. Any hopes that the replacement of Mario Draghi, which is Lagarde, she's the head of the ECB now, who on Halloween Draghi left the ECB more polarized than ever as the core European nations revolted against the Italians' sorry, I need my glasses. Profligately loose monetary policy in an unprecedented public demonstration of discord with the European Central Bank. With the ECB's new head, former IMF director and convicted criminal Christine Lagarde would result in some easing of tensions were promptly crushed when Lagarde picked up where Draghi left off, calling on Germany and the Netherlands to use their budget surpluses to fund investments that would help stimulate the economy. In a sharp rebuke that will not win the former French finance minister any friends in fiscally conservative Germany. Yeah, that was pretty rough when she said that. But in an appeal to Germany's sense of solidarity and in hopes that Germany's memory of hyperinflation has faded enough, Lagarde said that there isn't enough solidarity in the single currency area, adding, "We share a currency, but we don't share much budgetary policy for now." For now. Okay, so let me scroll down a bit. As for the punchline, Lagarde defended the negative interest rates introduced by her predecessor Draghi, arguing that people should be happier to have a job than a higher savings rate. This as a reminder comes at a time when virtually everyone who is not named Draghi or Lagarde thinks that negative rates are catastrophic and assure doom for the Eurozone. Let me just get this last one here. When asked about the impact of negative rates on savers, Lagarde said on Thursday, or last week, I believe, that they should think about how much worse the situation would be if the ECB had not cut rates as much as it had. Would we not be in a situation today with much higher unemployment and a far lower growth rate? And isn't it true that ultimately we have done the right thing to act in favor of jobs and of growth rather than the protection of savers? How do you like that? Rather than the protection of savers. So on one hand, I guess she feels, hey, if you have a job, you got some income, so be happy with that and don't be too greedy about trying to get any interest on that from us, the bank. Is that what she's saying? It's kind of what it may seem like to some people. Um, but it's just kind of reminiscent of that whole let them eat cake thing. Let's see a little bit more of the chat going on. Kirsten Strand, Dalio says we have a year to go before we see recession. So melt up for a year. Well, that thing, the so-called runway. I think there's a lot of guys out there, Pento, a few guys who have said we had about maybe 16, 18 months or so, 20 months of runway left, and we're already on that runway. So it. I don't mean starting from today. We're already into it. So if Dahlia was saying about a year, probably that's what the other guys are looking at as well. A year, maybe less, maybe a little bit more. But one thing for sure is when it comes 2020 election time, I tell you what, it's going to get heated up, and for better or for worse, depending on which side you're on, it's going to get heated up. No matter what. Again, it's something to be mindful of. Um, and the other thing, if Lagarde is saying forget about interest rates, I would say this: if you can't put money in the bank because you're not getting enough interest, visit our or create an account with us. Go to the P2P loans area, look at market, and you are going to see that there are people out there who are looking for some money. They need some loans. This person wants to borrow 6 months in Sing dollars, almost 50,000 Sing dollars. He's looking to borrow. Another one in USD, 6 months. Two guys are out there looking for loans of 100,000 USD each. Okay, so we have, and this is all backed up by gold, backed up by silver. As you can see, they're over the collateral rate, meaning they have more than they're asking to borrow. And right now, for them, their matching counterparts, there is none. So the way I'm seeing it, somebody has a good opportunity right now to come in and sweep this up. It's a loan for just 6 months. You probably could offer them 4%, maybe even, or well, there's one at 3.75, 3.75, 4%, whatever it is, and they may take it. And that is more return than you're probably going to get at a bank. So, Miss Lagarde, maybe you should direct people to our peer to peer if they want to have a higher interest rate. So anyway, one thing to keep in mind, that P2P comes from our peer to peer program, where when you store with us, your bullion doesn't have to just sit in a dark vault and not do anything for you. What happens is you can take a loan out against it, and you can redeploy your assets. So it's another way to get your silver and your gold to work for you. And there's a lot of ways that we can help you do it. So, send us an email, sales@silverbullion.com.sg, and just ask us about peer-to-peer. Or, if you have questions, you can just ask it here. But it's a good program. A lot of people have done it. And it's a successful program for both lenders and borrowers. So you might want to look into that. Um, what else in the news is? Hang on, let me check some of the questions once again. Let's see. Jack Yeoman, Craig Hemke, and other commentators have mentioned open contracts, silver and gold rolling over at the end of this month. What does that mean? Usually, whenever we see these open contracts, silver and gold is going to get hammered a bit. Usually, that's my opinion on it. So whenever Hemke warns you or tells you of open contracts, usually it means it's silver and gold is going to go down. But you never know. You just never know. Okay, and lately, of course, the repo market is still making news. Still making news. Something that we all thought was going to be, more or less temporary. It's still out there. And in an article from Business Insider, the Fed has been injecting hundreds of billions into markets since September's rate crisis. Here's why it might not be enough to calm lending conditions. So, looking at some key points, Federal Reserve has been boosting liquidity since mid-September when a spike in the overnight lending rate shocked the financial system. Central bank is using market repurchase agreements or repos and treasury bill purchases to inject capital into money markets, but many find the actions are ineffective in normalizing the key rate. So he's going to take a look at why it's not working. Federal Reserve has been injecting capital. Okay, we know that part. System for weeks to calm money markets, but the actions are prompting worry among analysts, portfolio managers, and even Democratic primary candidates. Okay, so this uh, red flag alert. This might be a biased article. Why are they just saying Democratic, right? I mean, I'm pretty sure there are Republicans also who are concerned, right? So okay, just just keep your guard on it. Maybe a little bit of a biased article. Nonetheless, the central bank is looking to boosting liquidity after the short-term funding rate spiked to 10% from 2% overnight in mid-September. The rate dictates how expensive it is for banks to access quick capital, and the unexpected jump symbolizes volatility in the usually stable lending market. Spike prompted the Fed to start injecting capital through overnight market repurchase agreements, repos for short, in mid-September, and the Fed also began monthly purchases of 60 billion in Treasury bills on October 5th or October 15th to keep its key interest rate within unintended range. This part here, the 60 billion in Treasury bills, the monthly purchases, this may be known as what's called reverse repo. Nonetheless, here's why the Fed's actions may not be good enough. Okay, Fed's injections cater to primary dealers or high credit banks approved to purchase directly from the central bank. While the large banks make up a significant portion of the lending market, non primary dealers are left with little assistance from the Fed's injections. The smaller banks are the most acute source of stress in repo markets and are set to take on greater burden as larger firms' reserves grow. JP Morgan Chase analysts wrote in mid October. Regulatory hurdles make it harder for cash to reach non primary dealers, and a lack of reserves at the smaller firms creates a weak spot in the lending market. Analysts at UBS echoed the warning, claiming the central bank doesn't know if there is a level of reserves that will solve the recent rate pressure. The primary dealers are only a subset of the demand for cash in the market, so the pressure in markets we have seen in the past week suggests that simply financing the primary dealers may be insufficient. The Fed is hoping that the money those dealers don't take from the market will be available to other borrowers. Uh, Hope is not a strategy. That's one thing I've learned. So Fed, don't hope, have a strategy. Okay, let's not hope because you're asking the banks to give up money. Good luck with that, right? Primary dealers are supposed to hold a certain amount of cash as a cushion for liquidity shortages, but the September crisis pointed to a disconnect between banks and regulators. Okay, here we go. Senator Elizabeth Warren penned a letter to Treasury Secretary Steve Mnuchin mid-October, warning him not to ease bank regulations, and we're going to talk about that in a bit. Following the liquidity scare, she questioned why banks are relying on Fed aid despite pulling in record earnings. Banks are reporting profits at record levels, and it would be painfully ironic if unexplained chaos in a small corner of the banking market became an excuse to further loosen rules that protect the economy from these kinds of risks. So in the end, and well, in the middle and the end, you knew this is going to be political. Um, it looks like what the banks are saying is, let us handle it. That's what they're trying to tell the Fed. Either let us handle it or loosen up the regulations that you're making us that you're having us to require holding more reserves. So that's pretty much what it is. So I'll take a look at some of the more questions. Um, Patrick, can you explain commitment of traders for? Hey, I'm with you guys. No, commitment of traders. I tell you what, I would say find Craig Hemke and listen to what he says because I think he probably explains it the best. And you know, I have my own definition of it, but I think Craig's explanation is far better. But I would say dig up some of his work and listen to what he says. Rumpelstiltskin, dear God, please don't bail the U.S. banking system again. Please, God, let it crash this time so we can finally try and get our freedom back from. Be careful what you wish for. It's not going to be easy. When that happens, it is not going to be an easy time for anyone. So, again, be careful what you wish for. Um, okay, so all this talk about Fed injection, repo. I just want to play a clip and let's go back to the beginning. The September FOMC meeting. I took a portion out of it with what Jerome Powell had to say. Um, and it was just the day before that we saw the repo markets get rattled and the Fed had to move in. And the next day was the FOMC meeting, and Powell had a few things to say. So let's go back a bit and recall what Jerome Powell said.
Let me say a few words about our about our monetary policy operations. Funding pressures in money markets were elevated this week, and the effective federal funds rate rose above the top of its target range yesterday. While these issues are important for market functioning and market participants, they have no implications for the economy or the stance of monetary policy. This upward pressure emerged as funds flowed from the private sector to the Treasury to meet corporate tax payments and settle purchases of Treasury securities. To counter these pressures, we conducted overnight repurchase operations yesterday and again today. These temporary operations were effective in relieving funding pressures, and we expect the federal funds rate to move back into the target range. In addition, as we've done in the past, we made a technical adjustment to the interest rate paid on required and excess reserve balances, setting it 20 basis points below the top of the target range for the federal funds rate. In a related action, we also adjusted the rate on the overnight repurchase facility to 5 basis points below the bottom of the target range. We will continue to monitor market developments and will conduct operations as necessary to foster trading in the federal funds market at rates within the target range. Consistent with our decision earlier this year to continue to implement monetary policy in an ample reserves regime, we will, over time, provide a sufficient supply of reserves so that frequent operations are not required.
Okay, so this is what Jerome Powell had to say back in September at the September FOMC meeting. Powell says what happened in the repo market has no implications on monetary policy back then. and temporary operations effective in relieving funding pressure. Back then, what we see today is it does have, or it does affect monetary policy, and it did have an effect in the temporary operations. I mean, the Fed is still in there. I think what Powell did was paint a picture that it was going to be short lived, a temporary thing, and I think he looked at just because it became the lending went out of range. At that time, the prescribed lending range or interest rate should have been between 1.75 and 2%, and it had gone as high as up to I believe almost 10%. And Fed jumped in and they squashed it. And I think they felt for the most part, or what they wanted us anyway to think was that the fire was put out. And it wasn't. We all know that the fire was not put out. Okay. Um, so then we went into October, and this was what Jerome Powell had to say recently.
We're mindful that continued below-target inflation could lead to an unwelcome downward slide in long-term inflation expectations. However, against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. Overall, we continue to see sustained expansion of economic activity, a strong labor market, and inflation near our symmetric 2% objective as most likely. While this has been our outlook for quite some time, our views about the path of interest rates that will best achieve these outcomes have changed significantly over the past year. As I mentioned, weakness in global growth and trade developments have weighed on the economy and pose ongoing risks. These factors, in conjunction with muted inflation pressures, have led us to lower our assessment of the appropriate level of the federal funds rate over the past year. In both July and September, we reduced the target rate for the federal funds rate by 1/4 percentage point, and we did so again today, bringing the range to 1.5 to 1.75%. The policy adjustments we've made to date will continue to provide significant support for the economy. Since monetary policy operates with a lag, the full effects of these adjustments on economic growth, the job market, and inflation will be realized over time. We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. We believe monetary policy is in a good place to achieve these outcomes. Looking ahead, we'll be monitoring the effects of our policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the Fed funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course.
Okay, so we know what he said in September and what he said in October. Basically this, interest rates are all about the 2%, the BS 2%. I mean, I'll just say that 2% is BS. If I had that little button that Gerald Salente has, I'd be pressing it right now for you guys. And he says, expect inflation to rise to 2%. Monetary policy lags, which is kind of a, you got to wonder. I mean, you're setting policy today for something that happened prior. And, I mean, how does that work? I mean, this is the reason why they have to do things slowly, because eventually, I mean, they don't want to get too far behind, but, at the same point, they don't want to get too far ahead. Me personally, I believe just get ahead of the curve, and then you can look back. Right now you're looking at things that have already passed you by. So if that's what you intend to do, I think you should get ahead of it and then look back and adjust accordingly, not always try to play catch up. I mean, that's just me, but hey, I'm not in the Fed, and probably for good reason. Fed may pause on lowering rates, and that's what it sounds like, where they may not do anything. Next FOMC meeting, they may take a pause. They may take a pause and reassess. Um, it's good and bad. It's good that you're not too aggressive and you can see where things are. On the other hand, the gap may just get a bit wider where next time around you may have to be overly aggressive. And this is all going to be very interesting because we are heading up towards election times, and it's this is going to play into the election. So we're going to have to see what happens. US elections anyway. um okay, so taking a look at some of your comments again. NFK2 killer, my cable bill went up 5%. I haven't had cable in years. I mean, I'm pretty much just watch YouTube, but no, I'm not watching myself. I just tend to watch YouTube quite a bit. Um, let's see, RR, we do not believe the numbers. I'd have to agree with that. I personally myself, I do not believe in numbers. Um, I don't believe in charts, meaning I'm not a fan of especially gold and silver price charts, commodity price charts, stock price charts. I'm not a fan of these price charts where if you're trying to use them to be forward looking, meaning you're trying to forecast on these prices, because I personally feel a lot of these prices are manipulated. So I'm not about to make a forecast on prices that were manipulated. Why would you do that? I mean, if you have bad data going in, you're gonna have a bad decision coming out if you're basing things on that bad data. So I'm not a chart guy. I mean, if you want to just look at the past and try and tie it to events, that's one thing. I can see that. But if you're trying to make a forecast, based on price charts and oh, here's this pattern, that pattern. Some patterns do work, but it's very difficult to tell someone that this pattern is now going to mean this or that. I think it's really tough to do today, knowing that you know a lot of what we're seeing is manipulated prices. So I'm not a fan of that. um let's see. Yellow State. Pudenda Johnson, I cut the cable 3 years ago except for internet access. We're in the same boat. We're in the same boat. Joel Maxwell and the Fed. I think we're going to hear more and more cries of and the Fed. It's. I think the Fed. I think you're going to hear more and more cries. That there's good reason why that may be a rally cry and soon. Coming up this week we have Kevin Smith from Crest Capital, and when I asked him about that inflation rate and other things, this is what he had to say. And I hope you guys do watch him coming up later this week. So, again, this is Kevin Smith from Crestcat Capital. Let's say we are heading into some sort of a crisis coming up. What do you see as perhaps one of the triggers that might bring it on?
Um, well, normally it's financial bubbles that tend to burst first that lead to the recession and what might bring it on. I think an equity correction could bring it on. I think perhaps rising inflation that takes people by surprise, and maybe it's a late cycle type of an inflation that hits first, could start taking people by surprise. And and we've seen when you've seen this risk parity trade become very crowded and popular. Long stocks paired with long leverage bonds. A lot of big hedge funds are doing this trade, and it's the idea is that, well, your bonds are going to counterbalance. They move, they're non-correlated, and so when your stocks are going down, your bonds are going up, and vice versa. And yet, if we get inflation, actually, this time around, it's negative for both stocks and bonds, and that could be a disaster type of a trade. So it could, it's something kind of out of the blue almost. That's not that people don't recognize as a bubble that goes wrong. The negative yielding interest rates. I mean, everyone, not everyone, but a vast majority of people, I think, believe that when we get into the next crisis here, that we're going to negative yields in the U.S. And a lot of people are already betting on that here in the U.S. And what if we get a different type of what if we have inflation instead, and the Fed can't cut rates because of that.
Yeah, or the Fed raises interest rates and they lose control. Um, Kevin Smith from Crescott Capital, he'll be our release later this week. Hope you chime in to see what else he has to say. But I think what the Fed is doing, it is concerning a lot of people right now, especially compounded with the repo markets, and rightfully so. I think a lot of us are trying to figure out which way they're going, which way are they going, and then we have to add on things like the trade war, and a lot of us we're starting to have a bit of a head spin. Where do we move? What do we do? And it's understandable. It's understandable. One more clip I want to play from Jerome Powell, because this is also what he had to say, I believe, about the repo market at this last FOMC.
In January, we made the key decision to continue to implement monetary policy in an ample reserves regime. In that operating framework, we control the federal funds rate primarily by setting our administered rates, not through frequent interventions to actively manage the supply of reserves. In the transition to the efficient and effective level of reserves in this regime, we slowed the gradual decline in our balance sheet in March, and we stopped it in July. In response to the funding pressures in money markets that emerged in mid-September, we concluded that it would be appropriate to maintain over time a level of reserve balances at or above the level that prevailed in early September of this year. To achieve this ample level, we announced on October 11 that we would purchase Treasury bills at least into the second quarter of next year, as well as continue temporary open market operations at least through January. These actions are purely technical measures to support the effective implementation of monetary policy as we continue to learn about the appropriate level of reserves. They do not represent a change in the stance of monetary policy. In particular, our Treasury bill purchases should not be confused with the large-scale asset purchase programs that we deployed after the financial crisis. In those programs, we purchased longer-term securities to put downward pressure on longer-term interest rates and ease broader financial conditions. In contrast, increasing the supply of reserves by purchasing Treasury bills only alters the mix of short-term assets held by the public and should not materially affect demand and supply for longer-term securities or financial conditions more broadly. Thank you. I will be happy to take your questions.
Okay, so no, don't call it QE, right? That's forbidden. We cannot call it QE. Anyway, summarizing, Powell says we slowed the balance sheet, liquidity froze. We now have a repo and reverse repo policy. In other words, he's going to make a U-turn, basically a V, if you were to look at a chart, which we'll take a look at later after I just said I don't like charts. I'm going to show you a chart, but anyway, the Fed, basically, Bernanke, he fired up the printing press, got all that money flowing out, money all over the place. And now we have Powell. He's trying to shovel all this money into a furnace. He's trying to get rid of all this money. And it's just kind of odd, why it's we work for this thing, we work for that piece of paper, and for them it's just let's make more, let's get rid of some, let's make some, let's get rid. How do you do that, right? It's almost evil in some ways, and that's a strong word. But anyway, one guy, he feels that someone might be broke and the Fed may be trying to help them out. And I think you guys know who this is. And I saw the comments, John Williams. I think we're going to work on getting John Williams back again. We interviewed him over a year ago, and I'd like to see also what he has to say this time around. But anyway, as I was saying, there is one guy who thinks someone might be broke.
Someone asked me, when's the next crisis coming? I said, well, we may be in one. The repo problems in the U.S. financial system, where the Fed, so Okay, so from 2008 to 2014, we had quantitative easing. Then there was a kind of a sideways period. Then beginning in 2017, the Fed initiated what they call quantitative tightening, actually reducing the money supply. I still run into people, they bang the table, I hate QE, you're printing money. I said, no, that's been over for about 5 years. They're now burning money, throwing money into the furnace to reduce the money supply. Except, just a few days ago, they slammed on the brakes on that and flipped to quantitative easing. The Fed is in the process, as we speak, of printing $1 trillion. They call it system repo, but it's QE4 in all but name. Why are they printing $1 trillion when they were trying to reduce the balance sheet? They were trying to tighten the money supply, and they're printing $1 trillion. Somebody's broke, and I'm not going to mention names. I'm not going to speculate, but they're giving the money to the banks, taking treasuries as collateral, but they expect the banks to lend the money to non-bank players, hedge funds, private equity funds, smaller banks, Chinese banks, etc., and take treasury securities as collateral. And the way it works is I give you $100 million and you give me $102 million of treasury notes or gilts. And so I've got 2% collateral, so if you don't pay me back, I sell the notes in the market and pay myself back. What does this say when the banks are hoarding the money and they won't lend it out and take treasuries as collateral? What it says is that they're anticipating a liquidity crisis that's so bad that they will not be able to sell treasuries at anywhere near the value they got. That's a pretty scary thought. That means they're seeing something the rest of us are not seeing.
Okay. And so taking a look at what Jim Rickards is saying on a chart, this is from federalreserve.gov. If you take a look at it on a chart, this is where we're at. This is when all of this repo madness started. The Fed was unwinding, or how Rickards described it as Jerome Powell is burning money, getting rid of money, throwing money in the furnace, getting rid of it. And all of a sudden, we need money. Basically, he had to reverse course. So here they were at 3.8 trillion. Now they are over, I believe, 4 trillion. So, we're looking at quite a large amount of money over a short period of time. And if you look at this, I know I said I don't like charts. I don't use charts to forecast, but for some things, you can. This is almost like a V pattern, or it is. I'll just call it a V pattern. V patterns usually happen when you want to change your mind, change your policy, change your whatever it is. You realize you made a mistake, and you need to make that U-turn. You made a mistake. You need to get back to where you were, and you need to do it quickly. So, Powell here. This is where we can say, as history moves on, where the Fed screwed up. This is going to be that point in history, that point in time where the Fed screwed up and the banks were starting to need help again. Now, the interesting part, when you if you ever come to this website, in fact, let me put the link here for you guys. I'll put it here for you guys if ever you want to take a look. Okay, the interesting thing is when you click here, this little drop down, and you look at selected assets of the Federal Reserve. Okay, this is what I find interesting. Look at the top two lines, that blue and that orange line. They are mirror images of each other. So if you go back to 2008, the beginning of the chart, 2009, they were starting to kind of separate a bit, and then all of a sudden they came back together, and let's just basically say this is where QE started to come into play. And then these two lines are pretty much in lockstep ever since. What these two lines are: total assets and securities held. So the Fed is buying up the debt. So let's just say the Fed is really buying up the debt. And this point here, this more than likely, I don't like to use the word all, but this more than likely was all because of the repo market, what we saw happening, this last edge here, and this last V, as I mentioned here. This is what happened in the repo market. And when you go to the New York Fed, okay, when you go to the New York Fed, sorry about that. Let me go here first. And I'll put this link for you as well. Hang on, let me get it for you. Because this is something you guys might want to take a look at also as well. So when you come here, repo and reverse repo operations, this basically breaks it down for you. The daily operations that they conducted in the repo markets. So we can see Friday, November 8th, 2019, the Fed did a reverse repo. Okay, reverse repo. And I'll explain what that is a bit later on. Okay. Almost $1 billion. Okay, with the reverse repo. Now we come into a repo, which is the same day, Friday, February, or Friday, November 8th. Sorry about that. Again, a repo. The collateral type, because the repos, the way they work is the banks, they need cash or liquidity. They give the Fed a security. The Fed holds the security, gives them the cash, and that security or collateral type here is a treasury. Okay, it's a treasury. So we can see submitted and accepted. Basically, it's what the banks needed and what the Fed gave. Okay, so we're seeing it at 63 billion one day. Okay, but here's the interesting part. You go down a bit, the collateral type, okay, which is treasuries. What else is the Fed getting into? Mortgage backed. The collateral is mortgage backed. Where have we seen this happen before? Okay, so where have we seen this before? Okay, mortgage backed. Sorry about that. I just had something saying I signed out. I don't think I signed out. Anyway, can you guys hear me? Is this live stream still going on? Because I'm showing that it is, but there was something that came on that said I signed out. Anyway, yeah, just let me know if it's still going on. Okay, so let me see. 20 still okay? Yes. Okay. All right. Thanks. Okay. I don't know why that flashed. I had kind of like a flash crash, I guess. Something flash saying I crashed. But anyway, mortgage backed. So the Fed is supposed to be buying treasuries, but they're buying also mortgage backed. And so let's go to Thursday, November 7th. Collateral type. It's just a treasury. But this is reverse repo. Reverse repos, the Fed is only going to stick with treasuries. Okay, but when we look at the repo, which is when the banks need liquidity, what do we see again? Collateral type treasury and mortgage backed. 8 billion, almost 9 billion in mortgage backed. So you got to ask what's going on, right? Why is the Fed getting involved in mortgage backed? I don't know. Maybe it's just a standard process for them, but I was led to believe that the banks need liquidity, so the banks are giving their treasuries as a security or as a collateral to the Fed, and the Fed gives them cash, and then the bank will repurchase later on. I did not know the Fed was also using mortgage-backed securities as collateral. So that, for me, it's a bit of a red flag because we know what happened just about a decade ago. So this is something we're going to have to watch, guys. This mortgage-backed securities that the Fed is also taking in as collateral, because these are repurchases where the bank is supposed to repurchase this back from the Fed. Well, what if the bank says, hey, you know what? I'll take the treasury back, but you can keep the mortgage back. I don't want that one anymore. I mean, what happens? Is that possible? I don't know. I'm not in the Fed. So again, this is why it's a bit of a red flag for me. I don't understand why they're taking mortgage back, especially since we know what happened last time around. Okay, and then we saw that term reverse repo. Okay, so what exactly is that reverse repo? Okay, so we know repo is when, again, the banks give their security as collateral or treasury as collateral to the Fed. Fed buys it, gives them cash, and then the bank is supposed to repurchase it a short time later. Okay, so let me see if I can find it here. Reverse repos, together with the interest the Fed pays banks on reserves they keep at the Fed, and the term deposit facility, help the Fed manage short-term interest rates after it raised them from rock bottom levels after the 2008 financial crisis. By controlling short-term rates, the Fed hopes to influence the broader economy to maximize employment and keep inflation near its target. The goal was for the reverse repo transactions to set a floor. Okay, so it's setting a floor. Remember what happened was those interest rates spiked, right? And the Fed had to get involved. That was the repo. The reverse repo, they're trying to set a floor where it doesn't go too far down. So the goal was for the reverse repo transactions to set a floor below which short-term rates would not fall. But policymakers do not want too many institutions to participate because, among other risks, that could draw money out of markets where people borrow. Okay, so that's why we have the reverse repo. Uh, One other interesting thing, if you go back to this New York Fed website, the FAQ on reverse purchase agreement operations. I found this one pretty interesting. It explains about the repo, the reverse repo, and things like that. It's a pretty good read if you want to understand it a bit more. I would suggest all of us do. And then you come down to one part where let me see if I can find it here, because this I thought was pretty interesting. I hope I can find it for you guys. Um, okay, the primary dealers. These are the guys that are in that have the blessings from the Fed. Let's say list of primary dealers. Current list. So who are the banks? Who are the banks? I guess I'm not gonna say all of them are too big to fail, but these are the guys that are getting the good deal, probably the cheap money, as they say. So we're seeing them here: BNP Paribas, Barclays, Bank of America, Cantor Fitzgerald, Citigroup, Credit Suisse, Daiwa, Deutsche Bank, Goldman Sachs, HSBC, Jefferies, JP Morgan, Mizuho Securities, Morgan Stanley. These are the guys, and there's not that many, but these are the guys that are getting the cheap money. I should say they're lending to each other at cheap rates, and they're supposed to be lending it out to the public or businesses or whatever it is they're just supposed to basically be lending it out, but it seems like they may not be. And some people say it's because you know the plumbing is backed up where they have the money, but because they have to hang on to so much reserves, they're not able to give it out. So the question then becomes, well, what happens if the Fed doesn't intervene the way they are intervening now? And I'll go down a bit. I'll scroll down a bit. Um, let's see. In fact, I'll just go to what it means for us, because I think that's more important. What does it mean for us? Okay. The scenario can play out a few different ways. If the Federal Reserve stops the bank bailouts each day, because that's basically what it is, then the entire system freezes, right? The plumbing gets clogged. This means, and we talked about this before, 401k withdrawals, IRA pensions, and more become insolvent. That would mean a major meltdown and loss for tens of millions of people in America. I don't believe the Fed or the governments want to risk that, so they will continue this QE operation for as long as the market will allow. So maybe that's one of the reasons why they are getting involved. Who knows? But if those 401ks and pensions and IRAs and all of that start to take a hit, I think we're gonna really. It's not gonna be a pretty time. So let me take a look at some of the comments again. Um, Sorry, that was a bit long. I just wanted to run through that with you guys. Mortgage-backed securities, yeah, banks dumping bad paper. Hard to say because the bank If they're buying back those mortgage-backed securities or not, I don't know. I mean, how do we find out? But we'll have to wait and see. Deutsche Bank also has a lot of mortgage, and Deutsche Bank has a lot of everything. Bobby Jones, one big scam. He nicely put, yeah. It could be, um, but these are the things. It can be hard to understand. So just take it piece by piece, little by little. Um, Try to understand a bit more and more each day, because a lot of things get lost in the jargon, and it's difficult to keep tabs on the Fed and exactly what they're doing. Um, Polynesian Pip, don't forget the don't forget the clowns. Amherst, Pierpont. Yep, okay, that was one of them. What happens? Banks close. There is said that one of these, well, one possible thing that may happen is a bank holiday. So we'll see what happens. Um, let's see. It's a paper, silver, and gold that is the scam. Let it all come down. Yeah, Steve, Beaver State Plumbing. Okay, so I guess okay, Oregon State fan. I guess yeah, the paper, silver, paper, gold. It's that's one of the things that does cause the discrepancy with the true gold and silver price. Um, RR, people should always have cash. That is true, and I mentioned before that in family offices, where the very wealthy go to manage their family fortunes, it's been coming out that these guys want cash. They want to hold cash. So a lot of family offices again are saying their clients want to hold cash. So keeping that in mind, remember there's only so many physical dollars printed versus digital dollars in the world. So when we talk about physical gold and silver and paper gold and silver, you also got to think about physical dollars and digital dollars. So you don't want to be caught not having enough physical dollars. You want to make sure you have physical dollars on you. That is what we're hearing from family offices. The very wealthy, they want the physical dollars as well. So keep an eye on that also. Federal Reserve is the scam. It's a family scam, and I think I'll come to that in a bit. Let's see. It won't crash until AI and 5G is rolled out to track and trace everything. It can be they're heading in that direction. There's so many ways that they can be heading right now, and you got to question, is it good for me, or is it good for them, or is it good for someone else? But I mean, always ask the question, is it good for me? Is it what I want? Because if you see the world heading in a direction you don't want it to go, you you got to say something. You have to do something. You have to say something. Wake up your friends, wake up your neighbors if you can. um but if you like where it's going, then obviously you'll support it. So it's each individual's decision. And the thing, with what's going on with this repo market, the Fed has to get involved, and but there is one banker who is saying, he has a solution for the Fed, and I'll just take you to the article with his solution. Okay, so right now it's been in the news where Steven Mnuchin is open to looser bank liquidity rules backed by Jamie Dimon, JP Morgan. Yes, of course, they would love to have looser banking rules, lesser regulations. Of course, that's what they want, right? U.S. Treasury Secretary Steve Mnuchin is open to loosening financial crisis era regulations that have stiffened or stifled liquidity rules for big banks to relieve possible cash crunches in short term funding markets. Mnuchin said in an interview Tuesday that he had spoken to Jamie Dimon, CEO of JP Morgan Chase, and other banks about how to avoid liquidity problems. Yeah, that's what you need to do. You need to ask the banks who caused a lot of this mess. You need to ask them for their solution. Yeah, I mean, you can't make this up, right? This is you just cannot make this up. The banks have raised an issue around intraday liquidity, and that is something that makes sense for regulators to look at. Mnuchin said while he was in Tel Aviv, his first stop during an 11-day trip. There may be a way around current regulations that creates more intraday liquidity without raising risks, according to Mnuchin. Turmoil last month that led the Federal Reserve to inject liquidity for the first time in a decade is largely a result of the technical issue of a corporate tax deadline draining money from the banking system, Mnuchin said, expressing a widely held view. Again, who's holding this view? The dysfunction has kept the U.S. central bank pumping money to quell a surge in short term rates that was pushing up its policy benchmark rate. The operation also eased the pain of hedge funds and broker dealers that need to finance their treasury holdings. Yeah, that's it. Let's trust Jamie Dimon, right? He won't do anything wrong. None of these banks will do anything wrong, right? That's why you were regulated, Mr. Diamond, because you did do some shifty things there that brought the system to its knees back in 2007, 2008, and you have a solution. Lovely. Okay, let's see. I warned my 5G. It's still debatable if there's some health issues with it or not. More of the same. Yep. Feed the beast. Yeah. That feed the beast, starve the beast. We're still feeding the beast. Let's see. No microwave in your house. Interesting. Uh, let's see. Cosmic citizen. The rich will say one thing and do another. Never trust their words. Look at their actions. The same goes for central banks. It's true. It's true. Joey Vargas. Why would physical U.S. dollars be important to hold on to if it loses value? To trade it for the new potential currency? Well, I agree with you there. The theory is if we do get into a pinch, some type of a crisis, let's take a look at Cyprus, for example. People were only allowed to withdraw $60 a day from the ATM. Okay, so let's say your only option is physical cash at that point. Let's say for whatever reasons, systems or whatever may not be working for you to transact. Your only other option is physical cash, and physical cash, I do believe in the beginning of a crisis, physical cash is going to be king in the beginning. Afterwards, probably not so. But in the beginning, you're going to want to have that cash because that's all people know. And at that time or in the beginning, people only know physical cash. And if you can't get to your physical cash, you're going to be asking people to go into something different, and they may not understand gold and silver like how we do. They may not understand anything else except cash. So it's good to have that cash, which more than likely is going to work for a while, not indefinitely. So that's the reason why you may or you should hang on to some physical cash. Um, let's see. QE equals repo and QT equals reverse repo. Different monetary policy tricks trying to achieve the same dirty Keynesian goals. Yeah, I mean, Keynesian policies, I personally like Austrian School of Economics. I personally like that. I personally like having a gold standard, maybe not 100% gold standard, but at least some type of a gold backing. I like the libertarian concept. But we're a minority. We are definitely a minority. People who think like that are a minority. And we these banks, they were set up a long time ago. Long time ago. I think some of you guys saw in the in the community group, I posted this excerpt from the book, the Killing of Uncle Sam. It was entitled The Money Cartel. And I'll just read it quick for you guys that haven't saw it. Despite their setback in America, the Rothschilds continued their global expansion by establishing financial ties to such countries as Austria, Germany, Russia, Italy, France, Egypt, China, South Africa, India, New Zealand, and Australia. In the process, they established close relations with other Jewish banking families, including the Cohens, Warburgs, Schiffs, Kuhns, Loebs, Lazards, Lehmans, and Goldmans. A lot of familiar names, right? These families worked together, shared resources, and engaged in joint business ventures. They shared a common Jewish heritage, maintained close social ties, and often intermarried. Okay, money marrying money. Natty Rothschild married the older daughter of Levi Baron Cohen, a prominent London financier. Jacob Schiff, who had lived with the Rothschild, moved to America and married the daughter of Solomon Loeb, okay, the head of the Kuhn Loeb banking dynasty. The two daughters of Marcus Goldman married the two sons of Samuel Sachs to form Goldman Sachs. Paul Warburg, excuse me, left Hamburg for New York, where he married Nina Loeb, the daughter of Solomon Loeb. United by blood, marriage, and ethnicity, they provided funding to American businessmen and industrialists, including Andrew Carnegie, John D. Rockefeller, and J.P. Morgan. In this way, they created a money cartel that has become the most powerful force on planet Earth. My question to you is, are these the central bankers of today? Are these the guys that own the central banks? It's well documented that the Federal Reserve is not part of the U.S. government. It's a private bank. Are these probably the same families that own the central banks today? What do you guys think? Okay, let's see. Avoid crowds. So conclusion: have water, food, guns, ammo, silver, gold coins, and stay home. Well, you got to get out and live your life, but you also need to know, what's going on in what's going on in the world. You can't just you have to know your what your adversaries are up to. Your competition's up to. You can't just keep a blind eye. You have to know what they're doing, when they're doing it, why they're doing it, and you have to adjust. You have to adjust and move forward and live on. Continue on with your life. Um, okay, so that was something I posted in the community group. I found it pretty interesting that money married money, and it's still here today. These same families, they're still around. And as I said, G. Edward Griffin, excuse me, he wrote the book The Creature from Jekyll Island, and he was the one that I think exposed a lot of us to central banks and the Federal Reserve and things like that. And he recently had an interview with Greg Hunter. So if you have the time, I Greg Hunter's a good guy to follow. Support him if you can as well. But this is what G. Edward Griffin had to say about these bankers.
So their thinking, I believe, is we're at the end, guys. Let's just make it for what it's worth. Grab all we can so that when the system collapses, we'll be okay. Now, that's kind of a crude way of putting it, but I think that they're going for broke because they know it is broke, and there's not much they can do about it. Now, what they intend to do, I think I know, and that is that they're waiting for the big collapse to come. They'll personally be okay because they will have amassed hard assets. They're trying to hold all the gold, all the silver, all the real estate, all the stuff that has value, the tools and the machines and stuff like that, the food supplies. But everything else, which is based on numbers and paper and debt and all that, that will collapse. And so they'll be able to pick up everything with like pennies on the dollar. Those who have assets will be able to acquire the rest of the assets that are being foreclosed on because the system collapsed.
Pennies on the dollar, acquiring gold, silver, other hard assets. Guys, that's stuff you can do too. I mean, this is why I say in chaos there's always opportunity, and these are some of the things that we can do. You can get the gold, you can get the silver. If you can, get some land, whatever it is. It doesn't have to be all gloom and doom. And that's the thing. If we kind of know what's coming ahead, you have an idea of what might be coming ahead, take out some insurance policies. If it, and these are things like gold, silver. Store of wealth, um, store of value. It's generational wealth. Uh, yeah, it does move up and down a lot. But the thing is, we're in it long term, and we're in it as an insurance slash investment. And as G. Edward Griffin said, and he would know central bankers probably better than anyone else because he's wrote the book, The Creature from Jekyll Island. If his take on it is, these are what the guys are trying to do, um, acquire hard assets, do it also. As I say, if central banks need cash right now, I need cash. If central banks are acquiring gold, I need gold. So you do these things, you do the best you can, and relax. Relax, enjoy things after that. It's just be prepared. You have insurance, and that's the whole thing. I mean, you have car insurance, you're relaxed when you drive. You have home insurance, fire insurance, you're relaxed when you take a trip. And if you have money insurance being if money should go bad, you have your insurance, you can be a bit more relaxed. So, these again are things you can do, you can do. And again, I keep saying this, if you have, your pensions, things like your 401k, talk to someone about rolling it over into a precious metals IRA because as I've said, that same stock market that's gone up and you've seen your statements go up, it's the same stock market that's going to go down and it's going to take your 401k down with it. So try, at least start, talk to someone about rolling over some of your 401k or whatever it is into a precious metals IRA. It's this is something you can do, and it's something that probably is in your best interest. And lastly, for guys in Singapore, I think we're looking for a graphic artist. So if you got some graphic artist skills, you're in Singapore, hey, give us a call, give us a shout. We're looking for some talented people. But again, I'll go through a few more comments with you guys, and then I'll be heading out. Uh, Polynesian Pip, aloha, how you doing? Elbo Sanchez, aloha, how you doing? Uh, Steve Brooks, my wife says I'm nuts and have gone way overboard. Welcome to the club, Steve. We got room for you on this boat. A lot of us, hey, as I say, we're all in the same boat. But kidding aside, guys, it's very important that your spouse understands. Your spouse needs to understand because I've seen a lot of times husband is trying to protect his family, the spouse doesn't understand, and her persuasion can lead someone to give up and walk away from precious metal. So I mean, the thing is, try and get your spouse to understand. Some of you guys mentioned Mike Maloney. I think he was a starting point for a lot of us. He was in the very beginnings for me as well. Um, we got to educate one another, and we're just, some people may see these things as crazy. I don't. I see it as, you know we're open, we're awake, and we're not blind to what's going on, and that's important. So again, if you're getting by day, paycheck to paycheck, still try and grab an ounce or two of silver. Just try and get what you can. Try and get some gold if you can. If you're very wealthy, do consider silver and gold as wealth protection, and do always consider moving it from your home jurisdiction to another jurisdiction, because when things do go bad in your home jurisdiction, it things can really go bad and get difficult. And if you're using this as your wealth protection, your generational wealth, um, if you need it to be there for you, you keep it in a safe place, not in a place where it could be a bit chaotic. So keep these things in mind. Big or small, talk to us. We'll do what we can to help you. Again, talk to someone with your 401ks. That's very important. You guys, you really need to just do it. Just do it. Um, okay, RR. I was lucky just to get out of California. Keep the silver, lose the spouse. Hey, okay, okay. I'm no comment there, man. I gotta. All right, I like that. Hard assets, guns, and ammo. Some people feel yes, you may have to. You may have to, and there's nothing wrong with that train of thought. Uh, I was tired of being terrorized by taxes and traffic. Okay, California. Um, Cosmic Citizen, have a great week ahead. Yes, you too. Definitely have a great week ahead. Uh, let's see. Should have done it years ago, but my learning curve was slow. I think most of us we I think when we look back, maybe we wish we could have started years ago. But main thing, you're in it now, and do what you can. Just do what you can. We're all here to support you. Let's see. 24K jewelry is a good mind changer for spouses. That is true. There are things like bullion jewelry. Maybe look into that. But again, she's going to need to know why. So explain to your spouses. Better late than never. True. Let's see. Does SD work with any particular precious metals vault custodians? SD, I'm assuming you mean silver doctors. I'm not sure. I'm not sure. But the thing is with like silver doctors, AppNext, all of these guys, yes, we are in the same market where, we do hope that people understand that they should be getting some gold and silver, but we're also in a different market where, you know, they're in the States and we're not in the States. So someone in the States probably won't buy from us unless they intend to store with us. Whereas, with these other guys, someone in the States will buy from them, if they intend to take it home or store in the States. So, in some ways we are the same market, but in a lot of ways we are also very, very different markets, which leaves a lot of room for all of us, as bullion dealers to work together, for vaults to work together to be able to give you much more options that are much more suitable for you, and that's something, again, you know their market is the States, and people their market is people who buy and keep it in the States. Our market can be guys from the States but choose to store it overseas. So again, it's same but a little bit of a different market. um let's see. Silver and gold spiked tonight briefly and were hammered down. Jamie Dimon on 60 Minutes. Any opinions? Didn't see it yet, but I'll take a look at it. Let's see. Okay, so I think that's about it. I'm going to be wrapping it up. And, I do thank you guys for being here and supporting us. I know, I had a 3 week break. Um, Not holiday break, just had a lot of work to do. So, I apologize for not being able to keep this a priority, but we're back and we'll do our best to keep it a priority. Um, it was just simply some guys went on holiday, and I had to cover for them, and that's really what it was. Everything's okay, nothing nothing mysterious was going on, or anything like that. So, but we'll try and do this again next week, and see what else comes up during the week. But you guys, you need to take care of each other, take care of your families, be there for one another, be a blessing, not a burden. And above all, saddle up for what's coming ahead and silver up as well. You take care, everyone, and we'll see you next week. Bye bye.